Gold Price Expectations, a Gold Price Forecast, Part 1. Gold prices have already pierced $3,400 in 2025, and as we look at the near-term expectations, the future of gold prices is a topic of significant interest for investors and analysts alike. Gold price predictions range from $4,500 to up and above $7,000 per ounce by 2030. As with any asset, it is important to bear in mind that, as the financial and geopolitical environment changes, the price of this precious metal will shift along the way to these predicted calculations, providing lower-cost investment entry points and opportunities. To read the full article right now, see the link in the video description. Also, if you think that your retirement savings are not keeping up with the cost of living, see the link in the video description to access the free inflation retirement calculator to make sure you are on track. In part 1 of this video series, we will discuss the current state of gold prices, factors affecting the gold price predictions, and more. Gold has long been considered a safe haven asset, protecting investors against economic uncertainty, inflation, and currency fluctuations. With global economies evolving, many wonder how gold prices will fare over the next 5 years. This article examines key factors influencing gold prices and expert predictions for its future. Current state of gold prices. As of April 2025, gold prices have shown resilience despite economic fluctuations. Gold has already pierced $3,400 per ounce, reflecting a more than 27% increase this year alone. This recent price surge reflects a mix of inflationary pressures, central bank policies, market uncertainty, and investor sentiment. Analysts are closely monitoring trends to determine whether gold will continue its bullish trajectory or stabilize at a lower range. Also, investors are looking for correction and consolidation periods in order to target buying entry points before the next surge in price, to essentially buy the dip. Factors influencing gold prices. Several factors contribute to the movement of gold prices, and understanding them can provide insights into future trends. 1. Inflation and economic policies. Gold is traditionally viewed as a hedge against inflation. When inflation rises, the value of paper currency declines, making gold more attractive. With ongoing monetary policies aimed at stabilizing economies post-pandemic, inflationary pressures remain a key driver of gold prices. Historically, during periods of high inflation or stagflation, gold has outperformed other investment assets, proving its role as a wealth-preserving instrument. If inflation remains persistent or increases, we could see more investors turning to gold as a reliable store of value. 2. Interest rates and central bank decisions. Interest rates directly impact gold's appeal. Higher interest rates typically lead to lower gold prices since bonds and savings accounts offer better returns. However, if central banks maintain low-interest policies, gold may retain its strength as an investment option. Central banks worldwide, including the US Federal Reserve and the European Central Bank, hold significant gold reserves. Any major shift in their monetary policies or an increase in gold purchases by central banks can further impact gold's trajectory. In addition, emerging nations within the Eastern BRICS nations have been increasing their stockpile of gold reserves in record amounts in the last 5 years. This high demand and limited supply will also place upward pressure on the gold price. Also, this central bank demand provides a stable price floor under the gold price. 3. Geopolitical uncertainty. Political instability, wars, and trade disputes often lead to increased demand for gold. Investors seek the metal as a reliable store of value during turbulent times. With global tensions rising in various regions, this factor will significantly shape gold prices. Gold prices spiked during past geopolitical crises, such as the 2008 financial crash, Brexit, the COVID-19 pandemic, and the Russia-Ukraine war. Future conflicts, economic slowdowns, or changes in international trade policies could once again drive up demand for gold. 4. Demand and supply dynamics. Gold's supply is relatively fixed compared to its demand, which can fluctuate based on consumer and industrial use. Jewelry demand, central bank reserves, and investment funds all contribute to pricing trends. If demand outpaces supply, prices will continue to rise. In addition, gold mining activities and technological advancements in metal extraction can influence supply. If mining costs rise due to labor shortages or increased environmental regulations, gold prices may be pushed higher due to supply constraints. Gold price predictions from experts. The wise Yogi Berra once said, "It's tough to make predictions, especially about the future." While predicting exact gold prices is challenging, analysts have made educated forecasts based on economic trends and historical data. 2025 to 2026, modest growth with inflation in focus. In 2024, investment firms such as Goldman Sachs and UBS projected that gold prices would maintain an upward trend, potentially reaching $2,800 by late 2025. However, this early gold forecast is of course outdated, now that gold has surpassed this price. Although there could be a correction and consolidation point around this range, which provides a more affordable entry point before the next surge in price. Inflation concerns and geopolitical risks may keep demand strong. A gradual economic recovery combined with ongoing global challenges is expected to maintain gold's appeal, though moderate fluctuations are anticipated. 2027 to 2028, stronger gains expected. With potential economic slowdowns, increasing debt levels worldwide, and stubborn inflation concerns, some experts predict gold may even cross $4,500 by 2028. Major investment funds will likely increase their gold allocations, especially if fiat currencies weaken or stock markets become volatile. The expanding middle class in emerging markets such as China and India may also drive higher jewelry and investment demand. As previously mentioned, the mass purchases by Chinese central banks and allied BRICS nations are providing a continued price floor, serving towards gold's price stability. 2029 to 2030, a potential boom. Long-term forecasts suggest that by 2030, gold could surpass $5,000 to $6,000 per ounce, especially if central banks continue to accumulate reserves and economic uncertainty persists. Some optimistic projections even hint at a $7,000 target if inflationary policies remain unchecked. And many analysts are now stating that even this range is too conservative. The role of digital gold investments and blockchain-based gold trading platforms is also expected to expand. These innovations may attract younger investors, further increasing market participation and demand. In Part 2, I will discuss further gold price predictions and expectations for the next 5 years as well as various investment options. Please like and subscribe so you do not miss the next video. If you have a minimum of $100K in savings to protect and want to take advantage of the most competitive gold prices, see the link in the video description to attend a free gold investment webinar hosted by Augusta Precious Metals. Secure your place today. Thank you for watching.